There are EB-5 projects seeking investment right now that owe more money than it costs to build them. If a project has been able to borrow from alternative lenders and EB-5 investors against the project's stabilized value, it may well be indebted for over 100% of construction and startup cost. Projects like this are being actively marketed to EB-5 investors right now. The people promoting them know exactly how badly leveraged they are, but in most cases, the investors don't realize it. If you are evaluating an EB-5 project, you need to know exactly how much debt is on the books, what kind it is, and what the interest and debt service costs are. We're going to do an overview of that now. In part 1 of this series, we covered 3 things every EB-5 investor needs to understand before committing capital to a project: how much debt the project is carrying, how the financial and legal structures affect your rights, and what mezzanine finance is. Part 1 is linked in the description. Today, we're focused on determining how much debt there is in the project, what the different layers of debt are, and how valuations are used to justify it for better or worse. We also discuss where in the books you should be looking for all of this. I'm Josh Godden, and I'm the Managing Director of InvestMigrate. We have spent 18 years looking at the financial structures of projects our clients have been asked to invest in. I can't give you investment advice, but I can tell you that the EB-5 project you're looking at might be carrying very substantially more debt than you realize. The capital stack. First, let's talk about the debt structure. Most large commercial real estate projects, like the ones EB-5 investments are typically based on, are funded through multiple layers of financing. You will hear this called the capital stack. It describes who financed the project, how, and what priority right they have for payment and asset rights if the project is successfully exited, or if there's a bankruptcy liquidation event, or any outcome in between. At the top of the stack is usually a traditional commercial loan from a bank. This loan is secured by a first mortgage on the property. Literally speaking, banks are lending pensioners' savings accounts, so they are conservative. They typically lend only up to 60 to 65% of total development cost, covering land, construction, equipment, and so on. The exact loan amount and terms are finalized in a binding commitment letter from the bank before a loan agreement is drafted and executed. Any lender or investor considering a position subordinate to the bank who has refused access to that commitment letter should be very concerned. As a prospective EB-5 investor, you are almost definitely investing into a subordinate position like this. There is a lost in translation problem where some EB-5 project managers or their agents tell EB-5 investors outside the US that the project's terms and agreements with other lenders are subject to confidentiality restrictions, and that this means EB-5 investors can't see these agreements. In the American English used by institutional lenders, subject to confidentiality restrictions means they sign a non-disclosure agreement and then see copies of the project's agreements with other lenders. If your EB-5 project manager refuses to adhere to the American English understanding of subject to confidentiality restrictions in this context, it's a serious red flag. Most developers can't put up 40 to 50% of a project's cost themselves. Even if they could, their equity partners mostly expect them not to, as this dilutes their upside. Therefore, there is almost always additional financing below the senior loan. However, banks must have a really extraordinary level of confidence in a project to allow another loan to have a lien or mortgage on the project's assets. So the additional financing below the bank usually can't have claims on a project's land, building, equipment, and other physical capital. This is where mezzanine loans come in. Mezzanine loans usually have no lien or mortgage against the project's assets. Normally, the mezzanine lender's security, if a borrower defaults, is the right to take ownership of the project in hopes of righting the ship before it defaults on the senior bank loan. Once again, a mezzanine loan is usually not collateralized by mortgages and liens on property. The other most common form of subordinate finance is preferred equity. Preferred equity shareholders get priority over regular shareholders when profit is distributed in exchange for accepting a limit on the maximum level of distributions if the project is successful. Some developers use this instead of or on top of a mezzanine loan. Where does EB-5 fit? EB-5 capital typically comes in below the senior bank loan in the capital stack. Developers hope to get better terms on subordinate debt or preferred equity in exchange for taking on the immigration regulation compliance and EB-5 investor administration burden that comes with using EB-5 capital. Managing EB-5 investment requires significantly more administrative and management overhead than traditional loans or investment. So getting cheaper subordinate financing in exchange for taking that on can be a fair trade for both sides. That said, there are also developers who go to EB-5 not for better terms on reasonable borrowing, but to exploit the fact that foreign investors may not understand what they are agreeing to. They entice them to supply cheap subordinate financing on terms American institutional lenders would find outrageous. Your EB-5 investment might be second or third in line to be paid back if something goes wrong, and it probably isn't secured by a lien on real assets. Whether these terms are reasonable or not depends on the specifics of each project, so you have to actually know what those specifics are before you can make that judgment. You cannot really know how much debt a project is carrying unless you understand what it costs to build and what its stabilized value will be once it is completed and operational. Every lender to the project, including your EB-5 investment manager, may be working from different stabilized value assumptions. That really matters. Banks always require an independent appraisal of the project for lending consideration. For large commercial real estate projects, these are prepared by firms like CBRE or Jones Lang LaSalle. They cover everything, including construction and startup cost, the value of the land, the building and capital assets, and finally, the projected financial performance and stabilized value of the business once it is operating. The bank's lending committee then reviews that appraisal, runs their own analysis, gives their own valuation, and decides how much they will lend. Commercial lenders are lending their depositors money, so they never lend against best-case projections. Whatever conservative valuation they're lending against will be in a binding commitment letter before the loan agreement is executed. Lenders below the bank, which may well be you as an EB-5 investor, could be working for more optimistic valuations. That is a deliberate decision. A project has to perform better to serve multiple loans than it would to service only the bank's loan. As you'd expect, subordinate lenders charge more interest and have stricter lending terms. EB-5 subordinate lenders should not be an exception. EB-5 project managers expecting somewhat better terms from EB-5 than they can get from American capital markets is fair, considering the extra work they take on to raise and service EB-5 capital. However, if your EB-5 project's subordinate lending agreement is really stunningly out of line with what American institutional lenders do, you should really ask yourself whether your EB-5 project manager sees you as their client or as their product. They may be prioritizing their relationship with the developer over you, even if they are not affiliated in the legal sense. This might sound shocking, but there are many reasons this happens. The most common is simply that regional centers want pipelines of marquee projects in famous locations that are easy to package up for foreign investors who aren't deeply familiar with the US. They come to market with projects in cities like New York or Los Angeles that are associated with famous five-star hotel chains or other global brands, and then work with foreign agents who do whatever they can to distract investors' attention from the details of the actual investment. Many EB-5 investors have no idea what valuations the various layers of financing in their projects are based on. It's hard to overstate how concerned you should be if this is you. When you are reviewing an EB-5 project's financials, pay close attention to what is being emphasized and what is not. Developers like to lead with EBITDA. That's earnings before interest, taxes, depreciation, and amortization. This shows how profitable a business would be if it hypothetically didn't have to pay its loans and taxes or to maintain capital assets. Hypothetical businesses aren't EB-5 qualifying though. Assuming it's calculated from credible data, EBITDA can help you determine whether a developer's plan to redeem your investment by selling or refinancing the project is credible. It absolutely will not tell you whether the project can cover its senior and subordinate loan payments every month in the meantime though. To know that, you must see cash flow projections that include debt service, full stop. You also need to know if those projections are base case, middle case, or best case. I can't give you investment advice, but I can tell you American lenders don't lend against best case. You also need to examine the possibility of more debt in the future. Does the developer have the right, under its loan agreement with the EB-5 project, to refinance at a higher loan-to-value ratio when construction is complete? Can your EB-5 project manager make unilateral decisions to allow the developer to take on more debt? Banks set limits on how much additional debt projects they lend to can carry. EB-5 investors in a subordinate position have just as much reason to care about this. Many of them have no idea this is something they can insist on, though. When you are evaluating a project, ask why the structure is the way it is. If something seems unnecessarily complicated, you must look very carefully at it. Reviewing quickly in closing. You need to know the total debt across every entity with recourse to the project's assets or cash in any way. You need to know what valuations all the loans are based on, including and especially what valuation the EB-5 loan is based on. You need to know the terms of those loans. You need to know where you stand if things go wrong, who gets paid before you, and what assets actually back your position. And you need to know whether the project can cover every loan payment across every loan it is carrying, and whether you have actually been shown those numbers. In the next 2 videos in the series, we cover how investment structure affects your rights and recourse, and then we do a full deep dive on mezzanine finance. If you are evaluating an EB-5 project right now, or you have been presented with an offering and you are not sure what you're looking at, we are happy to take you through the documents, show you where the terms are, and explain what they mean. Schedule a free consultation at the link below. Finally, don't forget that the grandfathering protection deadline for submitting I-526E petitions is September 30th, 2026. If you plan to apply, you should already be preparing. Get in touch with us.